Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently roughly 5 p.m. Eastern, Monday, December 5th. We're going to be doing some fundamental and technical analysis on the financial markets overall, looking at market sentiment, some precious metals such as gold, currency pairs such as GBPUSD, EURUSD, USDCAD, and GBPJPY, as well as looking at equities with the primary focus on US 30 or Dow Jones, whatever you like to call it. Okay? Before we jump into the meat and potatoes, which is of course the fundamental and technical analysis across pairs, some key things that we want to note and look out for. One, we are still very early into a new business month, of course being the start of December. So it's very common to see order flow and price setups into these new business month periods as the institutions adjust their order flow accordingly. Two, we're also, of course, winding down Q4, the end of the fiscal year, and just in a couple of weeks, coming towards European and North American holidays to, of course, into the New Year's as well, right? So we want to keep in mind that if you understand the seasonal changes in the market and understand volume and volatility changes through historical periods, that it's very common as we get closer and closer to the end of the year that the markets can be more illiquid, creating unfavorable trading conditions. So always make sure that as a manual retail trader, you stay objective, you stay logical and neutral, and you adapt to the changing market conditions. Whether that's periods of high volume and very healthy, easy to follow technical trends with good fundamentals, where you should be more aggressive and more active, or whether it's periods where the markets are more illiquid, having a lot more fundamental indecision and a lot more aggressive volatility, which can be more destructive to your account, where you should be risking less, potentially less trades in the market overall, and more sitting on the sidelines protecting capital. If you do not learn to adjust to the changing market conditions, fundamentals, and real-world events, the market will teach you the lesson itself by constantly pushing you to burn your account, over trade, over leverage, and so forth. Okay? So keep in mind those key events. Now, also a good reminder, and just to get the full education and full information and value for yourself for free. On top of this webinar, I also highly advise that you review and watch two other webinars in specific fashion, right? One being the educational market update webinar done last week for free on this YouTube. It was around an hour and 20, hour and 30 minutes long, but I highlighted what exactly would be happening through the entirety of last week. How we would range until Wednesday, how the main fundamental catalyst is going to be Jerome Powell's speech, and the potential impact of Jerome Powell's speech and how you can play it accordingly. Also, after you watch that webinar, make sure you watch the higher time frame macro analysis webinar, also on this YouTube channel for free, that was just uploaded today. It's around 40 minutes long. Watching that webinar from last week, on top of the higher time frame analysis, and this reactive live webinar now will really give you a ton of knowledge, information, and value to understand exactly what's going on in the markets and why. Okay? So now we're going to be continuing from that fundamental catalyst last week, which was Jerome Powell's speech. That is the main driving factor and main catalyst from Wednesday last week that started to bring a lot more volume into the markets in one-sided volatility for all of us to play to our advantage. What we had take place was Jerome Powell give a neutral to dovish sentiment, did not bring any hawkish events to the table, did not talk about any more rate hikes to come, did not talk about how long they will be keeping rates hiked, and he further supported the bias of stock market upside into the end of the year. If you watch the free educational webinars that was given, this was of course one of the scenarios we were looking out for to adapt to in terms of market impact. We understood that with the real world implications and connections of the stock market to our day-to-day life, on top of understanding the economic timing of coming towards the end of the fiscal year, and of course going into the holiday season in North America and Europe, that there was a higher probability we could see the one percenters and stock market, we could see the one percenters, corporations, and central banks in the short term supporting the stock market upside to keep consumer morale up, consumer activity up, investment activity up, and to keep this all the way into the new year. Then come into the new year, I have expectations that we'll see the stock market turn bearish, gold turn bearish, and dollar turn bullish again, as inflation will still be high, and the cold dark reality of the Federal Reserve needing to do more rate hikes and combat inflation will be the main driving factor into the new year. But until then, I can see up until Christmas having the extended historical Christmas rally on, of course, the stock markets, and of course also having some continued dollar weakness, gold upside, and playing that sentiment from last week. What we saw from last week was Jerome Powell's neutral to dovish speech talking about rate hike slowdown, further fueled the shorts and less demand in the dollar and more demand in your risk assets. This is why we gave the free analysis for gold buys on Twitter and on the Telegram, as well as on YouTube, above 1760s and 1780s to play up into the 1800s. Stock market buys still going up to 35K, in my opinion. And also understanding we're still going to be playing some of the dollar weakness and bearish structure and bearish price action on the dollar. We're still going to be looking to extend that sentiment, as when we're looking at the dollar individually here, you can see even though we're having a pullback for this new weekly and monthly period, we're still trending bearish with potential to go to 103s and 102s flat, especially as long as we're not trading back above 106.5 and 106 flat here. So seeing this short-term pullback phase as we're still early into the new business month on the dollar is not out of the ordinary at all. But let's zoom out here when we're looking at our risk assets, such as risk currencies, GBP and euro against the dollar, gold as a precious metal, and the stock market inverse to the dollar, as what's been holding the most weight since Wednesday is the Fed pivot prayers and hopes of a Fed slowdown fueled by Jerome Powell's speech. So when we're looking at the dollar here, for example, and you're looking at the overall structure, yes, on the higher time frame, we're still very bullish. But if you watch the educational webinar from last week, which was around an hour and a half long, as I already discussed, and you watch the higher time frame webinar, dollar can easily still come to price points around 103, 102 flat, as we're respecting this pullback structure to close off the end of the fiscal year before seeing buyers come back into play, as January and February 2023 inflation reports will still be very high, showing that the Feds cannot slow down with their rate hikes and they will need to bring the heat back to the table, bringing dollar domination back to the table. But from an intraday perspective and from a technical perspective, as long as dollar is still trading below 106, even around the 107 handle, we still have the potential to come down to these deeper, higher time frame demand zones before turning bullish again. The only way from the current price point that we're sitting at that I could jump back into a dollar domination bullish bias, counteracting the fundamentals of last week, that we would need to see that downside move from Jerome Powell's speech getting completely canceled out and breaks well above 108. If we don't get technical breaks above 108, If we don't have fundamentals compounding each other to bring back dollar domination, as it takes way more for dollar bulls compared to dollar bears, as it's way easier for the stock market to be bullish rather than bearish, understanding market psychology and the real world connections and implications of the stock market to the global economies, financial markets, and our lives overall, that it's going to take a lot for dollar bulls to come back into the scene. So for the start of this week, what we had take place was just a pullback from these new lows and some dollar strength, which was also induced by some more optimistic US data through the North American trading session. Through the North American trading session today, we had the global composite and services sector PMI showing signs of slight improvement, which can bring back some dollar bulls, and of course was the reason why gold had a more bearish pullback from the 1810 highs that were printed, and stock market was bearish, and also factory orders as well as ISM non-manufacturing PMI was also good. But even with this data being relatively optimistic and solid, it still wasn't enough to cancel out the Jerome Powell move or have dollar break back above those previous support zone broken price point around 106. So the main reason, on top of the new week, new business month, and this optimistic data from the US side, this is why we saw today gold have a deeper pullback from new intraday highs in the 1810s. This is why we saw GBPUSD have this pullback from intraday highs. And this is why we saw EURUSD pullback have these intraday highs, as well as US30 fail to break higher as well. It's because the optimistic, strong US data takes away from some of the Jerome Powell sentiment of last week, creating that pullback and less demand in your risk assets in the short term and more demand in the dollar in the short term. But that economic data was priced in and the impact faded from these pullbacks we've seen. You can see when we're looking at gold, when we're looking at the dollar, when we're looking at US 30 or EURUSD, GBPUSD is still very bullish on the intraday time frames above the 1.21 handle, as we're still having buyers print consecutive higher highs, showing buyer volume is much more prominent in the markets overall. And we're still having the majority of pullback phases just going to retest previous highs or significant demand zones of interest and still not breaking this bullish structure. At the same time, dollar is softer and there's more demand in your risk assets. So you can see this pattern across the board of any asset class and investment vehicle where the order flow has been primarily influenced by the Federal Reserve's monetary policy. Whether it's been the dollar domination and extreme bears on GBPUSD, EURUSD, gold in the stock market, as the market was pricing in the aggressive rate hike cycle, or whether it's been as that information's been priced in and we've had more data feeding into Fed pivot prayers, hoping of a rate hike slowdown, and of course bringing demand back into the equity markets now. That's what's been holding the most weight so far, is the sentiment of Fed pivot prayers, hopes of a rate hike slowdown, bringing some more demand into equities to close off the business year, having that seasonal rally in the stock market as well, which is taught in Capital Hungry educational webinars. So market structure is still very much intact. GBPUSD is just having a pullback from new intraday highs printed. The pullback is not breaking bullish structure. Gold, even though gold is having a solid reaction around the 1810s and previous significant liquidity zone of interest, it's still having a pullback from intraday highs printed. It can still easily revisit the 1760s on the intraday time frames and still be relatively bullish. We don't have any fundamental reasoning yet to see dollar domination back into the scene or to see gold turning completely bearish just yet, breaking well below the 1740s. EURUSD, same idea. Yes, we're getting a reaction at a higher time frame liquidity zone, which this has been explained in more detail in the macro higher time frame webinar that was uploaded today for free. that you can obviously watch after this to get even more in-depth information. But we're still having buyers print these intraday highs. Jay Powell's speech sentiment is still holding the most weight. We're still having intraday bullish structure, and the pullback makes sense into this new week and new business month, where even if we get pullbacks to like 1.04, Euro USD is still bullish on these intraday timeframes. US 30 stock market still bullish and can easily still dig up to 35K flat as per the previous market update webinar and higher time frame analysis. And we're still having this pullback occur from new intraday highs being printed, where if we don't have any major fear, uncertainty, or doubt, if we don't have any major hawkish confirms from the Feds or extremely optimistic US data to bring back dollar strength, every single one of these pullback phases that also comes from a new intraday high of buyers extending further to the upside just leads to a pullback to a demand zone, more buy orders to be collected, and still continuing this bullish trend in relief rally, which can easily extend into closer to the Christmas period as long as we don't have any fundamentals counteracting that, right? So just zooming out and understanding market sentiment, as long as we still have demand in global equities, whether they're ranging at their bullish highs or continuing to chug bullish, showing us that we still have order flow entering the risk assets, giving us a lot of information about market sentiment. As long as dollar is still trading below 106, 106.5, or starts breaking these lows, we're still playing the potential bullish bias on gold back up to the 1800s. We're still playing GBPUSD and EURUSD bullish bias, stock market bullish bias, and individual dollar bearish bias, as dollar can easily still dig into the 103s, 102s, and set up order flow of buyers into the new year, as I can see dollar domination really coming back into the new year and towards the end of this year when we have still consecutive high inflation reports and the Feds need to bring back the heat of more aggressive rate hikes and keeping rates up for an extended period of time. But until then, just to quickly summarize, I'm still in a short-term bearish bias on the dollar below 107 and 106.5. On an intraday perspective, I'm still in a bullish bias on gold above 1760s. On GBPUSD, I'm still in a bullish bias above 1.21 handle, roughly around previous highs and not canceling out this complete upside move. On EURUSD, I'm still in a bullish bias as long as we're holding above roughly previous intraday highs in 1.04. On USDCAD, we're still just having some intraday ranging here, but as long as we're still below 1.37, I can still see ranging occur or some deeper downside plays. On the stock market, US 30, as long as we're still sitting above 33,300, we're still bullish from a technical and fundamental perspective, as we don't have any new geopolitical tensions of fear. We don't have any fundamental catalysts bringing long-term dollar strength, and we don't have any continued hawkish Fed speakers or anything of that nature to bring back dollar strength as well. Now, what's had a little bit of tug of war and indecision is, of course, GBPJPY. But as long as GJ is still holding above this intraday demand zone at 165, even though the Japanese yen individually is holding some strength, it's still just doing a pullback from significant lows printed as we're approaching the end of the fiscal year, and is showing a lot of exhaustion by the buyers in this pullback phase at the retest of this previous liquidity zone where we've seen sell orders generated there before, leading into these lower lows. So as long as the yen individually, when you're looking at the currency index movement, doesn't trade back above 74.5 and 74 handle here, and GJ individually still holds above 165, I am still in a higher time frame bullish bias on GJ. Now, Before we jump into the individual technical and fundamental analysis across pairs now and give trade ideas, we just want to understand what economic events we have on the table. So in terms of economic events, nothing too important going on that's going to be impacting gold, US dollar, or US equities, as the North American session's looking a little bit quiet. But we do have some PMI figures and some economic data through the Euro and London trading session. At 2 a.m. Eastern, we have some expected rebounding figures from Germany, industrial orders, manufacturing, and consumer goods reporting, which can give some strength to Euro, especially against still a softer dollar at the moment, or even against the yen. Then at 3:30 a.m. Eastern, we have PMI reporting here from various parts of the Eurozone and Eurozone overall, which is still expected to show some minor signs of rebound, potentially similar to what we saw with some of the US PMI figures, especially as a lot of this negative PMI data from Eurozone has been very well known, very well priced in, and the market's adjusted for it accordingly. Then at 4:30 a.m. Eastern, we have some PMI figures for the UK, which I'm also expecting to be relatively solid, just hovering around prior figures, may just have a minor lower time frame impact, nothing too substantial at all. Then during our North American trading session, we have some international trade balance data for the US, won't have that much impact. Trade balance figures for CAD won't have that much impact. And then some 10 a.m. PMI figures for CAD, that will hold a little bit of lower time frame impact on the Canadian dollar individually, still keeping the Canadian dollar weaker, in my opinion. In terms of central bank and political speakers, nothing really important from the Feds, Bank of England, Bank of Japan, or anything of that nature. We do just have some ECB speakers scattered throughout the night. Now, on gold, we do have to be careful, as the area of interest we're getting a reaction to is a very strong liquidity zone, which this was discussed in detail in the hour-and-a-half educational webinar and the free higher time frame webinar. We expected that if Jerome Powell brought a neutral to dovish statement, still supporting stock market gains, that we could easily have an extension up into the 1800s and 1810s. But this would be an area of interest where we would have to watch for any type of major rejection or signs of exhaustion. Now, you can see that whenever gold retests a sell side liquidity zone, it doesn't just instantly start to drop. You can get multiple retests into a liquidity zone on the intraday time frames and daily time frame before turning bearish. I can't say that just this one rejection is sellers completely coming into the market just yet, as we still have demand in other risk assets such as equities. Dollar still looks soft, and we're just seeing a potential price setup for this new weekly period, which is completely in line with how the previous weekly candle closed, bullish engulfing above these previous highs. As long as gold is still holding roughly above the 1760s, not completely canceling out this bullish engulfing candle from last week, still maintaining some of that intraday bullish structure, I can just see this as a deeper new weekly pullback to generate more buy-side liquidity from better price points and still trending to revisit the 1800s again. For me to jump in gold sells, when you're looking at the intraday perspective, you can see as we had buyers print these highs, we had a pullback phase and a period of consolidation as we had market volume lower and slower, market volume and volatility lower and slower up until Jerome Powell's sentiment. Here we can have and assume that this was an accumulation of buy-side liquidity as we called buys to scale above 1760s and above 1780s, playing the J. Powell sentiment. I would need to be breaking well back below this range, completely canceling out the Jerome Powell move from last week, showing that that information's priced in, faded out, and sellers are back in control with sells back below the range and even lower. Otherwise, getting a break and retest of this accumulation of orders here and just having a deeper weekly pullback, which is still coming from intraday highs being printed, is completely normal on gold. Look at this example here. As we had buyers extend into these higher time frame highs into the 1780s, we had almost a 500 pip pullback phase. Still didn't break structure, had the accumulation of buy-side liquidity, a fundamental catalyst to bring demand back into gold and outflow out of the dollar, which was Jerome Powell's neutral to dovish speech, and still had buyers revisit these highs and extend even higher. Above the 1760s, I'm still bullish on gold, expecting that we can still range or still come back to revisit these highs into the 1790s and 1800s. For me to see sells, I would need to see these correlated confirms. Dollar bulls above 107 when you're looking at dollar index individually. Stock market bears. Gold break back below. Gold break back below 1760s. Otherwise, this is just a deeper pullback phase on gold. Very common as we're still early into the new business month, of course, and into the new week. And as long as we're still holding above this price sensitivity area, and what we can assume from last week was an accumulation of buy-side liquidity, we're not canceling out the J. Powell sentiment move. I can still see no sells unless we're holding below there, right? With those confirms. We don't want to just start to sell just because we had one large bearish engulfing candle, maybe get a little bit more downside and then just end up becoming a wick, end up becoming a part of the pullback, as we still maintain the integrity of bullish market structure with the pullback coming from new intraday higher highs. We're still respecting above 1760. And in terms of sentiment confirms, we still have equities holding at their highs around 34K on US 30. GU and EURUSD are still bullish. Dollar is still bearish as long as it's holding below that 107 handle. It's still just having a pullback from new intraday lows being printed. Very similar to any of these situations where these pullback phases can get faded out, still continuing the trend. Right? So when we're looking at gold, if we get retest, deeper double bottoms to retest structure here at 1764 and fail to break lower, higher risk, higher reward buys. Breaks back above 1772 and breaks above 1781 would still be gold buys in my opinion. Dollar stays softer. Equity strength. Hold above 1760s. LTF confirms of support and what's taught in the Capital Hungry educational webinars. I can only see gold sells if we're trading well back below 1759 key level with the confirmed stated, or if we were come back to the 1812s and have a more refined double top and failure to break higher. GBPUSD, we're going to understand a similar idea, as regardless if it's gold as a precious metal, investment vehicle and trading asset class, regardless if it's currency pairs with the dollar like GU or EURUSD, regardless if it's an asset class like the equity markets and looking at the US 30 stock market index, majority of these asset classes have been primarily influenced by the Federal Reserve's monetary policy. Whether it was the market pricing in the aggressive rate hikes and how we saw dollar domination for the last year and a half and gold bears to the 1600s, or as it's that information's been priced in and we've had more fundamental catalysts feeding into Fed pivot prayers, everything's been tracked back down to the Feds as your central catalyst, right? So as long as we're still having Jerome Powell sentiment holding the most weight, even getting pullbacks to 1.21 is still bullish on GBP USD. Pullbacks to 1.205, holds of 1.21 previous highs, just breaks back above 1.224, would still be playing GBP USD buys as long as there's still demand in UK equities, showing us that investment optimism, as long as dollars ranging or relatively softer, and as long as we don't have any fundamental catalysts to bring negativity to the British pound individually. I would need to see breaks well below 1.19 and 1.18 to jump back into sells with confirms of dollar domination, which we don't have yet. And there's still a lot of information that a lot of people are overlooking from the hour-and-a-half webinar given for free, and of course the higher time frame webinar recently uploaded. Euro USD, similar idea. We're still having bullish structure, bullish price action, just a pullback from new intraday highs. Still didn't fade out Jay Powell sentiment move. Even if we do come to that similar price point of interest and retest of that order block, I'd still see buys. 1.04, 1.045, 1.0525 would still be looking for Euro USD buys. Only sells at this point below 1.034. If the buy analysis is invalid, dollar domination comes back into the scene, and we have reasons to be jumping back into sells, not just playing any guessing games. USDCAD is more of a range here as we have a little bit of tug of war between dollar weakness and Canadian dollar weakness, as oil still relatively softer, and we've had economic data supporting less demand in the Canadian dollar. But breaks back below 355, below 35, and below 34, I would still be looking for UCAD sells, playing back to the lows of the range as long as dollar buyers do not come back into the scene. I can only be jumping into UCAD buys with clean breaks above this rejection point, which lines up with higher time frame key level 1.365. US 30 stock market index. Deeper pullbacks to demand zone 33,500. 33.2 just breaks back above 34K into the new daily candle. We're still having stock market buyers printing intraday higher highs, bullish price action and market structure. Dollar weakness sentiment still holding more weight. No fundamental fear, uncertainty, or doubt. Potential Christmas rally still extending into the holiday season, and price setups into the new fiscal year. I could only see sells below 33K, or if we were to come to revisit 35K at the highs and give major signs of rejection at that next liquidity zone of interest. Last but not least, GJ. GJ has been having some more ranging price action with the tug of war between strength in GBP as a risk currency and more demand in risk assets overall, and of course the yen having some short-term strength. As long as we're holding above this broken bearish structure in 166 and 165, I'm still potentially bullish on GJ to trend back to the 168s, 169, and 170 handle. On US 30, if you zoom out here, as long as we still have the Christmas rally holding weight, we're holding above some of these key liquidity zones of interest, still respecting intraday bullish structure, as well as dollar weakness, I can see us extending into this next liquidity zone of interest, which is roughly at the 35K price point. So as long as we're still maintaining bullish structure, We're not breaking, we're not shifting out of the higher high and higher low formation. We still have the optimism in global equities, still less demand in the dollar, Christmas rallies extending into the end of the year, setting up better price points into the new year for the whales to offload. I can see us revisiting this next liquidity zone of interest roughly at 35K, as long as we're still holding above that 33.2 handle. But yeah, GJ intraday timeframes, I can't see any sells unless we're trading below that daily demand zone where we see a lot of buy side liquidity generated at 165. Otherwise, pullbacks to 166, holds of 166.5, flipping bullish above current highs, and breaks above 167. I'm still looking for GJ intraday buys from these levels and scalp buys. Remember, for even more information to get a full understanding of what happened from last week into this new week and expectations into the end of the year and as well as into the new year, please watch the hour-and-a-half webinar that was done last week, Market Update, where we had the secondary bias of a neutral to dovish Jerome Powell and that impact come through. Also, a lot of updates that were sent in the free Telegram analysis channel, and check out the higher time frame webinar that's been posted. This is going to be saved and uploaded. You can always re-watch it as you wish, and I'll see all of you later. 45 minutes of straight value, information, fundamentals, technicals, market sentiment, some key reminders, economic events, and trade ideas. Make sure you like and subscribe. Share this around on your social media and your other trading communities and groups, and I'll see you next time. Maybe some point this week for a New York scalping session on Wednesday or Thursday.